Good morning. It's Friday, the 10th of January, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital. The top stories and themes as we go into this weekend, the markets are still sliding away and down. The Reserve Bank of India wants to improve its data forecasts. The Indian mobile phone market has stagnated, thanks to which half of the manufacturing capacity of 500 million phones is lying idle. Some 52 or 59 ultra-luxury properties worth about 4,700 crores bought in India last year were in Mumbai as sales values for these properties keep rising. And sticking to luxury, Mercedes has record sales last year and is optimistic about this year too. And sticking to cars, electric car maker BYD of China sells more hybrid cars than electric. Did you know?
This is a Counterpoint with Govindraj Ethiraj.
The markets continue to slide away. Nothing, it appears, can stop the market sliding, and the bears continue to win the day, or at least end of trading day, despite a strong fight back by the bulls, at least on some days. Thursday was clearly not one of those days. The benchmark equity indices, the BSE Sensex and NSE Nifty50, closed down again, with the 30-stock Sensex falling 528 points to close at 77,620. The Nifty50 also was lower by 162 points at 23,526. Both indices were swinging to and fro, though not as much as we saw on Wednesday. Broader markets were also on the same path, with the Nifty Small Cap 100 and the Nifty Mid Cap 100 down about 0.9% and 1.3% respectively. So here is one reason the markets are weak. An increasing number of foreign investors and brokerages are still bearish on India at this point. HSBC, for example, has cut its rating on Indian equities to neutral on Thursday and cut its end 2025 target for the BSE Sensex by 5% to 85,990. This obviously means, as you work backwards and forwards, that there's a 10% upside for the Sensex, which is trading at about 77,700 levels right now. Now, this is also roughly what fund managers and analysts have been predicting in recent months, at least in December. And the term that's often used is muted, as is the case here as well. The cyclical growth slowdown and elevated valuations have capped the upside in the near term, and we see muted market returns in 2025, HSBC said in a note reported by Reuters, which added that last year Goldman Sachs and Bernstein Quants had already downgraded India's stocks, citing a slowdown in economic and corporate activity. On the other hand, some brokerages like Citi and Morgan Stanley have forecast double-digit returns from Indian stocks, while Motilal Oswal, another brokerage, said it saw healthy corporate earnings growth in 25-26. Interestingly, the benchmarks are now back to 10% below their record highs, which they had temporarily lifted themselves up before returning to where they are today. India in January had forecast an annual growth of about 6.4% in the financial year ending in March. This is also the slowest in 4 years, thanks to a weaker manufacturing sector and slower corporate investments, and that has been covered by us in the last 2 days. After hitting multiple record highs until September last year, the Sensex and Nifty have pulled back and now, of course, begun a fresh retreat, down almost 3,000 points in the last week alone. Otherwise, the benchmarks have posted their 9th straight annual gain in 2024. And here's a quick flashback, courtesy Reuters again. More than 50% of the 54 firms in the blue chip Nifty50 index that reported earnings so far, that's in November, had either missed analyst estimates or reported results in line with expectations. Now, banks which have the largest weightage in India's listed universe are struggling as strict policy measures from the central bank have slowed down demand for credit, according to HSBC. Growth in the technology sector is also weak because of a slow recovery in overseas demand. Though rural demand shows signs of a recovery, consumption in urban areas is muted, HSBC said. And more on technology with TCS results coming up. The only good news, if so, from HSBC is that Indian equities are relatively insulated against an uncertain global backdrop and could benefit from any change in trade policy. That's obviously a positive change by the incoming Donald Trump administration, which is, of course, not too far away as we speak. The rupee too continues its slide. The Indian rupee continued to wilt under a strong dollar and, of course, dollar outflows. The Indian rupee hit a lifetime low on Thursday, pressured by a rise in US bond yields and strong dollar bids in the non-deliverable forwards market, while the Reserve Bank of India likely stepped in to curtail losses, according to traders who spoke to Reuters. The rupee declined to 85 rupees 93 paise per US dollar, sliding past its previous record low of 85 rupees 85 paise hit in the last session. TCS results are out. Tata Consultancy Services, India's largest software company, also owned by the Tatas, and the first major company to declare third quarter results, posted smaller than expected third quarter revenue on Thursday after the key North America market underperformed for the fifth consecutive quarter, according to Reuters. So its consolidated revenue increased about 5.5% to 63,000 crore rupees for the October to December quarter, falling short of analyst expectations of 64,452 crores. According to Reuters data, once again, net profit rose 12%, sounds good, to 12,380 crores, but analysts expected 12,399 crores of profits. An analyst told Reuters that revenue growth was below expectations, but the third quarter is a seasonally weak one as most clients ramp down operations due to the holiday season. Analysts also said that in terms of deal wins and operating margin, things were looking better, and that could further improve if there was better business flow from the United States in coming months. India's IT services industry is worth about $254 billion and has been slowing in recent years as major companies and corporations in US and Europe have slowed down on spending. The industry is also in the center of several protests against H-1B visas in the United States, though the use of H-1B visas by Indian IT services companies of the likes of TCS, Infosys, and Wipro has been slowing down quite sharply in recent years. The United States accounts for about 40% of the overall Indian IT sector's overall revenue. TCS's total order book stood at about $10.2 billion during the quarter compared to $8.6 billion in the previous quarter and $8.1 billion in the year-ago period, according to Reuters. Smartphone manufacturing capacity is lying idle. Nearly half of India's mobile phone manufacturing capacity, established under the government's Production Linked Incentive Scheme, or PLI, is currently underutilized or repurposed thanks to declining global and domestic demand, according to a report in Business Standard. Capacity is high because there is far more capacity that's been created than there was demand for, including the fact that the domestic market for smartphones has remained the same at around 150 million smartphones for more than 4 years now. Data from research from Counterpoint Research shows that India's mobile phone production capacity reached over 500 million units by the end of 2024. Of this, some 250 million unit capacity is lying idle, and for various reasons which we'll come to. This, of course, has strategic implications and insights for mobile phones in specific, but manufacturing in general, when it comes to tuning for and anticipating both global and domestic demand. Many manufacturers, that Business Standard report said, had shifted to produce telecom equipment or wearables or even shutting production. I reached out to Tarun, research director at telecom and technology consulting firm Counterpoint Research, and I began by asking him to walk us through what the total capacity versus demand was at right now and why there was this gap.
It's an interesting topic. So we started tracking this manufacturing in India almost like in 2014 when this all started. And there was basically what we look at is divided into three phases. One is when 2014, 15, 16, when everyone started assembling in India. So that was the time, right from two OEMs, Samsung and Nokia, they used to manufacture, assemble in India. But then everyone raced to assemble in India. So that was the phase one. And suddenly we have seen a lot of OEMs started partnering with the EMS players, opening up the lines because the cost to assemble a phone was not huge. And then obviously there was some duty deficit as well. And then there was this phase two, which was phase manufacturing program that was launched by Government of India, which essentially states that you need to also now just not do local assembling of mobile phones, which is basically you import parts from other countries and merely assembling it here. So you need to basically localize as well. And there were different phases where the components were divided and the duties were levied on that so that the local sourcing starts happening. So that was the phase two. And essentially we are now in the phase three, which is being driven by PLI, Production Linked Incentive, which essentially states that, okay, now you are doing assembling, you are also locally sourcing something, but now your incentives and everything will be linked to the production of the devices you are doing. So that has basically consolidated operation of a lot of OEMs because to get this incentive, OEMs normally went in favor of couple of EMS players that have the potential to do that or potential to hit the targets. So what we have seen that right from the phase one, when everyone started on their own or smaller players moving towards the larger players like Dixon's or the Foxconn of the world that have an incentive to produce more to qualify for the PLIs, and that transition has led to a lot of these smaller EMS players exiting from the business. So they exited in multiple ways. Either they sold these capacities to the bigger players, or those are like just idle and being converted into different. So as a result of it, we have seen that we have technically a production capacity which is as big as like 500 million to produce 500 million units across feature phones, smartphones, and tablets. Currently the production output is only 250 million, which is necessarily the half of which is being utilized. Technically we can scale our manufacturing assembling to that level, but the point here is right now it is largely being driven by domestic consumption. Like for example, whatever India is producing, it is meant for domestic consumption, and export is only 20% of it, and being done only by two major players, Samsung and Apple. So I think the export part is a miss here, and that obviously with certain capacity and the domestic demand, you can only produce that much. You can sit on a surplus.
Right. So let me pick up on 2 or 3 points you made. So one is you said that a lot of small players were absorbed by larger players. So the gross or the aggregate capacity is still the same, right?
Yes. So either it largely remains the same, or they're still looking at what to do with these smaller factories. So, for example, there are even smaller players like no one even like very few people have heard. Like, for example, you have companies like Cohort, Consort Digital, Creators Corporation, Excellence Mobile Tech, KBR. So that list goes on to almost like 62 to 65 players. But then, as the rule of industry is like top five is almost like top six is almost like 90-95% of the market.
So these factories were like subcontracted earlier, or were they OEMs in?
Subcontractors. OEMs were very few, like Vivo had their own, used to have their own, and then Oppo, Samsung has their own. They were not doing for others. Mainly, although the Oppo is doing for their sub brands as well, like Realme and not sub brand, but technically, yeah, they're doing for OnePlus.
Right. So therefore, there are two different things. So one is you're saying a lot of smaller factories which came up as subcontractors to larger ones have got absorbed because they couldn't survive as standalone entities. And the second is aggregate capacity of the larger ones now, which includes the smaller ones, is only working at about 50%.
So what also happened, what this PLI did, so let's say I'm a factory X and I started with a certain OEM, let's say OEM A, and that OEM A was giving entire capacity to me earlier, let's say 4 million per unit. So I have that capacity working for that OEM. So I build a factory which has a capacity to produce at least 5 because I always want to keep it a buffer. But now that OEM, what it did, it started to diversify. Instead of going with that EMS X, it says like, hey, let me go to EMX Y and Z as well, because these are the two EMS that also qualify for the PLI, and maybe I'll get some. So so now what happened now that EMS X can't basically shut down its own capacity because it thinks that maybe I'll win over some of the business from other EMS. So it is still idle, but again, the point is we are utilizing 100% of local demand through this assembling, but only 20% of the export is being met.
And which is mostly Apple and Samsung, as you said. So, what's the likely outcome of this? The fact that we have so much spare capacity at this point, and with the market only growing very slowly, even if it is.
Right. So there could be two alternatives to it. One is like you increase your export, because export technically, if you look at China is exporting almost like a billion phones, right, from their manufacturing. And it's a manufacturing powerhouse of the world. Let's say if Trump government comes into power and there is some kind of tariff barriers. So India stands advantage, right? So you still have those geopolitical China plus one strategy that everyone is looking at maybe comes in favor of India. And export India still has a huge export potential, I believe. We are still scratching at the top of the surface because none of this, think of it as like Chinese brands have 75% market share in India, but only 2% in terms of export contribution, which is like they can technically export from India because in PLI they were not being given the benefits. Let's say Oppo's own factory, Vivo's own factory, but now things are changing. Vivo has partnered with, like, it's a JV with Dixon in that. And then we have seen Transient going to a similar route where Dixon has taken over the iSmart, which is again their factory. So these things are happening. But if, let's say, India, that is currently doing almost like 50 million of export right now, imagine that number becomes 4 times in a couple of years. Then we are somewhere 250 million internal demand, 200 million exports, will be somewhere closer to 450.
Assuming what you're saying is that the technical capacity to produce those phones capable of exports or to meet export requirements in the case of, let's say, an Apple or a Samsung, which is higher end, is already there. But my other question is, what was the expectation when all of this capacity was being created at such speed? I mean, was there an expectation that we'll hit 500 million phones in terms of manufacture?
I think everyone saw it in a silo basis. So everyone, like all these factories, players, they didn't see this because the duties were 20%. It all started 20% duty is huge, and then everyone thought, okay, we'll get some mix of like smaller models. Feature phone market was big at that time, and then feature phone also declined. So everyone thought like, okay, maybe we'll cater to some, and it's an easy model in a sense, like you start a factory. I think margins are still in 1 to 2 to 3% in that, but and number of like investment is like 5 to 6 crores to start a line basically. So barriers to entry was low, and then they all started. But then market also went into consolidation. India market is still at very similar level as we were during the COVID level. So if you look at 2020, market was at 150 million smartphones, and it is still at like 4 years down the line at 153 million. So even the smartphone market didn't increase at the level everyone expected. China, in a sense, is close to like 270 million with the same population. So we still have some room to for growth in this segment. But at the same time, that's something which everyone missed. And I believe we are sitting at the excess capacity because of that, and then maybe partly due to the PLI.
Tarun, it was a pleasure speaking with you as always. Thank you so much for joining me.
Thank you so much.
RBI wants to revamp its forecast. India's new central bank governor, Sanjay Malhotra, has initiated a review of the Reserve Bank of India's inflation and growth forecasting tools to bring down projection errors, according to Reuters, quoting sources. Malhotra, who took charge last month, is asking the Reserve Bank's internal teams to include new data sets, analysis, and projections in their inflation and growth forecasts. All of this comes after increased scrutiny on the central bank's growth and inflation estimates, which have been off the mark for much of the current fiscal year, with growth on track to be much weaker than expected and inflation higher. For example, at the December policy meeting, the Reserve Bank cut its growth forecast to 6.6% from 7.2%, that's for 24-25, while retail inflation projections were raised from 4.5 to 4.8%. Now, this is in the context of India's GDP growth, which fell to 5.4% in the July to September quarter, its lowest in 7 quarters, even as inflation rose. The Reserve Bank of India says Reuters may increase data sets required to gauge trends in income and expenditure better and include, for example, trends in small ticket digital payments, as well as data from food delivery apps and online taxi aggregators. Reuters also reported a source saying that Reserve Bank of India's forecasts on inflation typically go wrong because food prices are pretty volatile. They rely on wholesale market data for the same, and that's what makes it prone to errors. India's production-linked incentive glitches. Apple supplier Foxconn Technology and Dixon Technologies India are asking the government to pay them billions of rupees in subsidies they think they are entitled to under the government's Production Incentives Program, or PLI scheme, according to Bloomberg. The government had pledged a total of 41,000 crore rupees or $4.8 billion in subsidies to manufacturers, and part of that remains unallocated because companies didn't meet estimated production targets. The companies, however, argue that according to the program rules, they are eligible for some of the allocated funds, according to people who spoke to Bloomberg. Now, industry experts the core has spoken to in the past have also pointed out some of the administrative challenges in getting PLI benefits deposited in their accounts and suggested the delays were holding back the true potential of manufacturing growth in India. Bloomberg said that companies want to see the administration follow through on regulations that have led to significant investments, including Apple partners who assemble something like $14 billion of iPhones locally, as they did in last year, and as they also diversify beyond China and Vietnam or countries like Vietnam. It is illustrative to note that in the case of contract manufacturer Dixon, for example, Bloomberg says the government is reviewing whether the supplier made new investments for producing Xiaomi Corp's smartphones or whether machines were merely shifted out of another factory which previously assembled the Chinese brand's devices, one of the people said. And all of this obviously makes the whole prospect of giving and collecting PLIs or benefits from the government for manufacturing much more complex and difficult. Sales of high-value flats are soaring. The last year saw at least 17 property purchase deals worth over 100 crore rupees each. That's 16 in Mumbai and 1 in Delhi, National Capital Region. Of these 16 in Mumbai, 14 were apartments in Worli, Malabar Hill and Pali Hill, and 2 were bungalows in Kafpur in JVPD, that's Jew Villeparle Development Scheme. Moreover, of the 59 ultra-luxury homes sold in 2024, at least 52 were in Mumbai city, or 88% of total deals. Delhi, National Capital Region, was next. Property research firm Analyst, which compiled these figures, says that the number of sales as well as the sales value of these assets has hit new peaks. Many of these, as we've noted at the core, are also purchases made by promoters or founders of companies who've seen exits either through IPOs or offers for sale in 2024. Mercedes sales are shooting up too. India, of course, continues to see a luxury buying frenzy, whether it's in property or now in cars, even if the rest of the economy is slowing. Luxury car maker Mercedes-Benz plans to roll out 8 new models, including battery electric vehicles this year, as it looks to build over its record sales in 2024, which was at about 19,565 units, which was up 12% compared to its previous year, that's 2023. Mercedes said sales of its battery electric vehicles also doubled in 2024. The company said 1 of 4 vehicles it sold last year was a top-end vehicle with a price tag exceeding 1.5 crore rupees. Mercedes told wire agency PTI that the new launches would be a mix of new models as well as fresh versions of the existing lineup. It introduced 14 models last year in India and is, of course, optimistic on sales growth continuing in 2025. The company said it's starting the new year with about 2,000 cars in its order bank. Hybrid is scoring. Hybrid-powered vehicles are proving more popular than battery ones, even in China, as consumers shift away from gas-only cars, according to full-year data reported by CNBC last week. India, too, by the way, is exhibiting a similar trend, with hybrid car sales growth overtaking electric car sales last year quite noticeably. BYD, the Chinese car maker and the market leader, said in a filing on Wednesday that it sold about 4.3 million passenger cars in 2024. However, some 2.5 million of these vehicles were hybrid powered, a reversal from 23 when it sold fewer hybrid than battery electric, said CNBC. CNBC also quoted Joe McKay, president and CEO of Auto Forecast Solutions, saying that we still see growth in the Chinese market in terms of battery electric, but we see it sort of capping. He also forecasted that by 2031, there would still be demand for internal combustion engine-based vehicles, including from hybrid-powered cars. And this, of course, is useful to note because it's quite likely the way in the Indian market could go, or rather is going already as well. And before we go, here is some feedback from all of you. Thank you, first of all, as always, for writing this patiently and noting your comments, which of course is very useful to us. So Prophet Nama says, just discovered your channel, love the content, recommended your channel to all. Thank you very much, Prophet Nama. Himanshu Soni says, no tadka, no masala, good old news reading. Keep up the good work. And that's really our objective. We don't want to have any masala or any tadka as such, but we do want to give you some insight as much as will help you take more informed decisions in your work or your enterprises. Dr. Krishna Kittu says, no nonsense, simple, straightforward information. Love it. Have subscribed. And finally, Ocean Star says, how can India benefit from a weak rupee when we are at a net trade deficit and our imports exceed our exports? by a big margin. And that's a very good point, Ocean Star. It's not something that can have a binary answer. There is one school of thought which says that we should have a weak currency because that's where we are in terms of real effective exchange rate. And the other school of thought is that we should have a stronger currency. The weak currency proponents obviously believe that that makes us more export competitive. And the others obviously believe that a stronger rupee is a sign of economic strength. It's tough to take a view, at least in such a short time, except to say that there are some industries which definitely benefit and there are others which lose. And as consumers, obviously we could lose too, because remember that when the rupee depreciates, our oil bill goes up and we have to pay more, and we expect to pay more as of even right now, as the rupee goes past 86 rupees to $1. And we have to pay more for every barrel of crude that we buy, and 80% of our crude is imported. So yes, that's a concern, and it does make life difficult and inflationary, but I've given you the other side as well. So all in all, I definitely address this issue more and more because it's not an easy one to get a clear, one-sided view on, but I think it's good to listen to all the views because both sides in some ways benefit, whether a strong rupee or a weak rupee. So on that note, thank you very much for listening in. Please keep sending us your feedback, which helps us produce more informative and insightful reports every day. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.